The Nifty scaled new peaks every day this week, finally closing above the 26,000 mark for the very first time. And global markets continue to rejoice the fact that we are getting rate cuts from two major central banks. The market ended higher for the third straight week. Hello and welcome to another edition of Editors Roundtable. Today we put the spotlight on China's big stimulus push, decode India versus China and how that story is stacking up, and of course tell you why large caps finally seem to be finding more favor versus mid caps. I'm Surabhi Upadhyay, and joining me on Editors Roundtable as always, Nimesh, Prashant and Nigel. Also with us in the studios today is Anish Tawakle, co-CIO equity at ICICI Prudential Mutual Fund. Anish, welcome to the roundtable. As you probably heard, we have lots of very interesting data points to go over, and we're really looking forward to hearing from you.
Yeah, looking forward as well.
But as you said, Surabhi, I think the two big talking points is central bank cuts.
Yeah.
In a way, the Fed opened the door, but China is the country which went through that door, right?
Absolutely.
Yeah. I mean, the Fed said, well, Kato, and China really started. In that, I mean, actually, it's true.
Yeah.
And the big tailwind really is central banks who are probably even emerging market central banks will be feeling a little more comfortable because, I mean, the big one which is starting to cut.
I think in markets, the biggest moves happen when you get something which is not entirely fully priced and fully anticipated. And this time it was on the way up, and there was China. While we were talking about the 50 basis points rate cut from the Fed, the real newsmaker turned out to be the PBOC. And just to quickly talk about the context and the setup, and what are the key trends that are coming out from this week's action here in India. Number one, the fact that it's China calling all the way, sizzling market. And to put the numbers in context, the Hang Seng is up 13% this week. It's the best weekly performance of that index in the last 26 years. The index has moved above 20,000 once again. But it's still a far cry, a long way off from its all-time high level of almost 33,000. So that's the China story. In comparison, Nifty's up 1.5%. The Nasdaq, as of Thursday, is up about 1%, and the S&P 500 0.7%. So China is the story. Let's talk about what that has meant in terms of the sectoral trends that we saw here in India. That's the second major trend that kind of stood out for us. The fact that commodities are back in vogue, and how, particularly metals. So let's put the numbers up for you on the screen. The metals index has surged 7% this week. The Nifty commodities index is up 4.5%, and even oil and gas up 4.5%. Of course, on Friday, there was the added tailwind. There is a fall in oil prices happening because of the expectation that Saudi Arabia will start boosting output. And we saw what that did to a lot of the oil refining and marketing stocks in particular. The other trend, newer sectors have joined the party. Auto surged almost 5%. The PSE index, by the way, came back. So after falling 20-25% from the peak, there's some interest that's still alive and kicking in PSU stocks. That's another trend you simply can't ignore. And pharma continue to find favor as well. Relatively speaking, IT and banks, the two huge pillars of the market, they haven't performed that well. The Nifty Bank is absolutely flat for the week, and the IT index put on about 0.5% or so. So very interesting sectoral churn is what this week was all about. The other major trend that Nimesh will talk more on is this big shift, the much-awaited shift from small caps and mid caps to large caps. Is it really happening? Well, going by price action, we are getting some evidence of that. So this week, the Nifty is up 1.5%. The mid-cap index is up just about 0.5%. Small cap index is flat. But you look at the month itself, and then the numbers get even more pronounced, because the Nifty is up nearly 4% this month, whereas the mid-cap index is up just half of that. Finally, coming back to China, the question really is whether the move in China, this tactical move, will lead to a shift in flows at all. If you look at the FPI data, while the rally has been domestic driven, in the secondary market, there's still a lot of FPI liquidity coming in, maybe through the blocks. Look at the numbers. September has seen the highest FPI inflow so far this calendar year at nearly 49,000 crore rupees. So China presents a very, very interesting question to us at this point in time. And I know Nigel has been looking at lots of data around this move.
Well, that's right. But before we get to that, Anisha, I wanted to ask you, how are you feeling about the market? So we had a very, very good month of September out of nowhere. October is seasonally a good month, both for the Nifty as well as the Nifty Bank. So that's what history suggests. But how are you feeling about the market as of now?
So market valuations are fairly rich, right? But that's in the context of a reasonably healthy economy. So the way we see it, I think small and mid caps are clearly very richly valued, and we'd avoid that. Any equity allocation has to be concentrated towards large cap. But even within large caps, it's now difficult to find too many cheap stocks. So For retail investors at this point, we are recommending asset allocation products, right? Products that switch allocations between equity and debt and maybe look for a better opportunity to enter equities than today.
In fact, Anish, you spoke about asset allocation. Gold has done so well in the last few months. Is this a time now to look at X of equity into other asset classes, including gold and real estate? Is that something you will recommend?
So, I mean, real estate you should buy for living there, right? I don't really see putting too much money as an investment asset in real estate. Gold has done well because there's been a lot of central bank buying. See, I think what I'm saying is it's okay to be in fixed income for a little while, even though returns are not great, and enter equities when there's a better opportunity, right?
All right. Well, let's turn the spotlight on this India versus China theme then. And earlier today, Prashant was telling us, did you hear David Tepper overnight? Because he said, buy everything China. Anything with it that has China with that.
And we were discussing what stood out for me. I don't know if you saw the interview, David Tepper on CNBC US. The anchors asked him, well, you're a hedge fund, so how do you hedge? Yeah. You're saying buy everything China. He said, well, I don't know what it meant, but it was really cool. He said, well, I'm sitting here, I'm wearing a suit, and I don't care.
So basically, David Tepper believes that China is going to do well from here on. And also, if you look at the Hong Kong ETF, besides the price movement, the volumes were the highest that we have seen in the last 5 to 6 years on. So let me put it in context and go across to the ball then. India has been the preferred market. The question is, will China outperform just in the near term? So India is the one that you want to be there on a structural story, but could there be a tactical shift to China? And will China come to the party finally? Let's put up, all the headwinds for China and all the tailwinds for India. India, well, the big macro tailwind, low energy prices, the demographics are in our favor as well. Consumption has been strong, onshoring as well as lower unemployment. Those factors have worked for us. While for China, well, the housing bubble has been an issue. They have been having their geopolitical issues, both with the United States, with Taiwan as well. And the business confidence has been depressed out there. The youth unemployment is another factor that's working against them. But if I just pull up a chart of MSCI India and compare it with China in dollar terms, you'll see it was pretty much working okay. And then from 2020 onwards, there's a bit of a breakaway that we saw in the MSCI India markets. And that's the reason why, in fact, all the reasons that I put up for you on the screen, that's exactly the reason why, in fact, we did play out. And if you market weight of the MSCI AC World IMI Index, India, in fact, has taken over China out there. But the one we normally look at is the MSCI Emerging Market Index. And out there, India, around 4 years or so ago, the weightage that India was occupying was only around 8%. China was at around 45%. Now, they've quickly, almost converged now because India is up to nearly around 20%. And you have China, well, that's come down to around 25% or thereabouts. So just take a look at the big move that we have seen all the way from that 8% mark all the way to around, the 20-21% mark. And that's another reason why India has been getting a larger part of the funds. Now, Chinese authorities, they believe that they need to stimulate the economy and they want to see, them achieve the GDP growth target of around 5%. So a few measures that they've done. The reserve requirement ratio, they have cut it by around 50 basis points. They're talking about 20 to 25 basis points from here on. That could free up close to around a trillion yuan for new lending. So that's point number one. The other one is the stock market, the capital market focus as well. And with the measures that they have come about, what could happen is it could increase the capital market participation. And point number three is the property market stimulus. They've spoken about reduction in the down payment as well as EMIs. And what could that lead to is higher consumption out there. So these are the three broad factors. Now, finally, what about India versus China? On a valuation front, well, just to refresh our memory, India is trading at nearly 21 times or China at around 11 times. And the flows picture, we have been seeing big redemptions from China, while you're seeing inflows into India. So will there be some kind of a switcheroo that's taking place? Indications are that in the past couple of weeks, we have seen that happen. So interesting to see, India appears the darling for the longer term, but in the near term, will the markets turn to China for a bit of a fling? So that's important. Anish, I wanted your view on this particular debate, India versus China. We used to ask a lot of our market guests, and suddenly we stopped asking about that only because it became that India's...
Came in town. Right?
Yeah, that's what we believed. And now suddenly over the last fortnight or so, again, the focus is India versus China. Your take?
So, if you look at some of my published portfolios, we have significant China holdings there. And China is definitely cheap. We've always held the view that Chinese economy is not collapsing. It's going through a period of transition.
Okay.
What do we mean by that? They were in a stage where they were building lots of cities, building lots of houses. They're done with that, right? They've built all the cities they needed to build, they've built all. So now spending has to shift from investment in housing and infrastructure to consumption, which is what this stimulus is meant to encourage, right? It's encourage more consumption spending. So I do think the Chinese economy will do well, and the Chinese market should do as well as well.
So in the near term, you think a tactical move towards China in comparison to India will play out?
I do think Chinese market will do well. I think, look, India has for me always been a domestic story. If we get the domestic economy remains in good shape, it's not necessarily India versus China, but I do think if the Indian economy does well, if earnings growth is good, the Chinese market might do better. I mean, it's okay, but India will not do badly as an economy.
Right. Got it.
I'll just take 1 minute more and just wrap up this entire China thing. We've had so many instances, right, of stimulus, all false starts. Share aaya, but share did not come. In the sense that market had rallied, but never really went anywhere over the last 4 years or so. So I just want to put out these points in terms of why people particularly excited about what's happened in the last 48 hours, actually in the last 24 hours. Because up till this point, most of what we heard from China and the authorities was on the monetary policy side, very little in terms of fiscal push. That is the big change, which has not happened. It's expected to happen. So, for example, yesterday there was that sort of unusual, unexpected Politburo meeting chaired by President Xi. There was also a report of large capital injection into banks, which means banks can lend more. But the problem is that there's already so much debt out there. So will borrowers come in and buy? And that's where real fiscal push, I mean, in that sense, helicopter money. And I'm not using that word lightly. This is why Reuters, and this is what the report said, the proceeds will also be used to provide a monthly allowance of 800 yuan or $114 per child to all households. It goes on with some other details. So they're actually talking about money in the hands of consumers, like what we saw in the US. So for the first time, it's not happened before, for the first time they're talking about fiscal stimulus, and that's the reason why this sort of added excitement. As I said, there have been at least 2 other big rallies in China since 2020. So the graphics will come up. The first rally was the COVID pivot. That was the 4th quarter of 2022. Market moved up 53% in 3 months. The second rally was in the 1st quarter of 2024. Market moved up 41% in 4 months flat. Guess what? From the lows of September 11th this month, the Chinese market is up 22%. So, you don't have to be completely convinced that this is the thing. Even if it is tactical, it doesn't last. The point is the rallies are very large when they happen, anything between 40 and 50%, Anish, right? So for our viewers here, can they get exposure? Fund of funds, etc. Any thoughts?
I mean, there are funds in the market. I wouldn't like to pitch any specific funds, but there are
sense for investors here right now.
Look, I always feel having a diversified exposure makes sense, and as part of that diversification strategy, China also makes sense. I mean, in some of our funds, like the business cycle fund, we do have China exposure. Yeah.
So Anish,
where we are allowed,
rather than talking about India versus China, should it be India and China? Because one of the thought processes, if China does well, EM does well. And if EM does well, the flow into EM's funds will also mean automatically we get the 20% share, right? So, and we've seen this historically, when EM does well, India also does well. So should we look at more of China doing well to India? It helps India as well.
See, we've not been short of flows, right? The market, if anything,
it's all about flows.
But then we've had domestic flows, so it's not that the market valuations have been constrained by flows. So at this point, I would not want to build a case based on flows for the Indian markets, right? If anything, India has had too much flows.
Too much of flows, yeah.
Right. So one should focus on earnings growth, and the outlook is reasonable, but so our valuations are also very rich, right? So I wouldn't want to say, look, let's get more excited about India because of flows.
No, but Anish, I think just to complete the picture, and then we'll take a break and come to the local story here. Tactically, would you expect foreign portfolio investors, till now they've been coming in via blocks, etc., and it's been a domestic rally, if they tactically start taking profits in India to move that money to China as a short-term tactical trade, will that cause an overhang, or are you guys already flush with so much money it wouldn't matter? You'll simply, pick up whatever they're selling?
post facto, if and when the correction happens, we'll always find reasons for why it happened, right? So the reality is, look, corrections happen when valuations are rich, right? And we are not sitting on cheap valuations. So it could be because of this, it could be because of something else. But at this point, one shouldn't rule out that we can't see a correction in India and stuff like that.
Fair enough.
I think, Surabhi, the point that Nimesh was making, look, 95% of foreign money in India, 95% comes
It's through
from
EM funds.
emerging
funds,
market
and
funds.
there's China there.
There's China there. So if China gets money, we get
Should
our
be good
money
for us,
in whatever percentage that we have. So that's
and let's see if there's any other sort of specific, selling out of India dedicated funds, but anyway, they're smaller in number.
I'll add, India, because while we are talking about inflows, right, India is also seeing a lot of paper supply, right? So the promoters are selling, MNCs are selling. So at this point, right, arguing for more flows, you also see more supply of paper coming in. So
Anish wants more supply, not demand.
So I think he won't mind even if foreigners want to sell a bit and move to another market because there's paper there for domestic institutions to buy. In fact, we need to take a quick break on that note. On the other side, the other major theme that's coming to surface, which is this whole shift from mid-caps, small caps to large caps. How do you play it? Back in just a moment with that.